Real estate syndications explained in 60 seconds. In a real estate syndication, you have two groups, the general partner and the limited partner. The general partners are the deal guys. They're the guys that are putting the entire transaction together, from finding the property to securing the financing to putting all the investors together, dealing with the broker, negotiating the contract. All of that is done by the general partner. Now, the limited partners are passive investors. They are investing into the deal, and that is it. Their risk is limited to the amount of money that they put into the deal, while the general partners generally sign for the debt, which means their exposure is a lot higher. Now, the limited partner's exposure is limited to the amount of money that they invested into the deal, while the general partner's exposure can be a lot higher than that, especially if they sign for the debt. Now, depending on the structure of the offering, there could be dozens, if not hundreds, of investors in the limited partnership. With each of these limited partners investing $50,000, $100,000 plus, this is how groups take down large assets, by pooling together investor capital in a limited partnership structure. Now, every deal is different, but the limited partners usually get a preferred return on their investment, which means that they're usually getting 6 to 8% on their money on an annual basis before the general partners get a dime. After that, the GP and the LPs split the remaining profits. Profits are generally split in what is called a waterfall structure, which means that the more the property makes, the more the general partner makes. That way, incentives are aligned, and the GP is incentivized for the asset to overperform. The higher the returns, the higher the split is for the general partner. And the limited partner gets to invest into an appreciating asset that creates a tremendous amount of tax advantages for them. Make sure to follow and subscribe for more investment tips and strategies.